If you're old enough, you'll remember Bob Barker used to say on The Price is Right, come on down. Well, I think a lot of business owners are hoping interest rates get that message. I know I am. But as I start thinking about 2027, well, I'm not building my plan around cheaper money. Frankly, I don't think you should either. Here's what I'm watching. Well, over the last couple of years, debt markets have been on a pretty wild ride. They hit a low right around the end of or beginning of COVID. And now we're seeing something particularly interesting, especially at the long end of the bond market. Governments around the world need enormous amounts of capital. By the way, this is not an Econ 101 conversation. But at the same exact time, big tech is spending hundreds of billions of dollars building the infrastructure behind AI, hoping for productivity gains. Data centers, NVIDIA chips, power, networking, you name it, real estate. Like all of this stuff has to get built and somebody has to finance it. So we essentially have governments and some of the biggest companies in the world, hyperscalers, big tech, all competing for capital at the same time, at the same duration. And that matters because long term interest rates have been moving higher and higher, and the 30-year US Treasury is now hovering around 5.25, 5.3%. Now, if you're a small business owner, you might say, well, Dan, I'm not buying those 30-year Treasury bonds, so why do I care? That's a fair question. You should care. You care because the cost of capital eventually works its way through the entire system, the entire economy. Think about commercial real estate. Think about that acquisition you're looking to finance, even with SBA debt, private equity, business valuations, even your local bank lender. The hurdle rate you should be thinking about before making that next investment in your company. Well, this is where history gets kind of interesting. At least I geek out to it. If you go back to the tech boom around 99, 2000, we had a massive investment going into technology, fiber optics, telecommunications infrastructure, kind of like no different than what's happening today with AI. But there was one huge difference. Our federal government was actually running a budget surplus. Have we heard of that lately? Government borrowing was going down. Today is the total opposite situation. We have massive government financing needs happening at the same time. Same time, some of the largest private sector infrastructure investments are happening. We haven't seen this in decades. And that's a very different setup for small businesses. And I think it's a mistake to simply just assume, well, the Fed will cut rates and money will get cheaper again. I don't know. I don't have a crystal ball, but maybe not. And that's my job, right? Is to deal with a little bit of the unknown for businesses. The Fed can bring down short-term rates while longer-term borrowing costs stay, stubbornly high. I've spent the last few years learning not to build a business plan around the outcome. I hope that happens. You build a plan around what you can control for sure. So, I don't know. As we start putting together our 2027 and 2028 operating and long range plans, I'd build three scenarios. What happens if borrowing costs do fall by 1%? Great, we're in the money. But what happens if they stay exactly where they are? And more importantly, what happens if they actually go higher, especially after you've done that long term financing deal, an acquisition, CapEx? Then look at what each scenario does to your business. Think about hiring, CapEx, acquisitions, I don't know, debt service. What about your cash reserves? Like, oh, and for the pass-through entity owners, how about owner distributions, growth investments? That's really what FP&A is about. It's not about creating some beautiful spreadsheet that predicts exactly what happens 12 months, 24 months, 3 years from now, because it won't. It's FP&A is always wrong. FP&A isn't about predicting perfectly the future. It's about creating enough visibility, margin, and liquidity that you still have options when things turn south, when the future looks a little different than what you expected. And it's not always to the negative, it could be for positive, for opportunities. That's something I've learned firsthand operating Growth Lab. At Growth Lab, I'm not assuming cheaper money right now. It's not going to save the 2027 plan. If rates come down, great, I'm happy. But we'll have more options. The plan needs to work if they don't. And yes, Bob Barker, I'd love to look at interest rates and say, come on down. I'm just not betting my 2027 plan that they're going to listen. So be ready. Get your pull out your Rolodex, call up your lenders, reconnect with those stakeholders that do provide you with liquidity, and build out your 2027 plan. Anyways, I hope you enjoy this month's newsletter. I always enjoy and geek out to economics.